If you woke up tomorrow and discovered that the money in your wallet had lost 90% of its value compared to 5 years ago, what would you do? Continue going to work as usual, or start looking for ways to convert all your assets into something more real? Imagine an economy where one United States dollar once exchanged for around 70,000 rial, and just a few years later, that number surged to 700,000 to 800,000 rial. This is not merely exchange rate volatility. This is the collapse of trust. When a currency loses 10 times its value, every salary contract, every savings account, every future plan is effectively reset. Inflation is not just a percentage in a report. It is smaller meals, a postponed dream of home ownership indefinitely, and a younger generation forced to remain dependent for many more years. From a macro financial perspective, the story is clear. When budget deficits persist, oil revenues are insufficient to cover spending. The government is compelled to print more money. The money supply grows faster than real economic output. According to basic monetary theory, when the amount of money in circulation increases sharply without a corresponding increase in goods, prices will respond. But more dangerous than inflation itself is inflation expectations. When people believe prices will rise further tomorrow, they accelerate consumption, hoard foreign currency, and withdraw money from banks. A self-reinforcing spiral begins to form. In Iran, the black market for foreign exchange becomes the real central bank. The official exchange rate exists on paper, but the actual price is determined in currency exchange markets. This reveals a harsh reality when citizens no longer trust the exchange rate announced by the state. Monetary policy becomes nearly ineffective. The domestic currency at that point is no longer a store of value, but merely a temporary medium to convert into United States dollars. Gold, or hard assets, the group most severely affected is not the wealthy. Those with assets shift into foreign currency or real estate. The poor have little to lose. It is the middle class that is eroded. They have fixed salaries, modest savings, and aspirations for upward mobility. When inflation rises sharply but income does not adjust accordingly, purchasing power declines rapidly. A bag of rice multiplying in price while wages remain unchanged means each hour of labor generates less real value than before. That is an invisible tax imposed on the entire society. Rising youth unemployment further weakens the economic structure. A country where nearly 1/4 of young people cannot secure stable employment faces long-term risks to productivity and social stability. When graduates are forced into temporary or informal work, the economy loses human capital, an asset more valuable than oil. What I want you to consider is not just the story of Iran, but the mechanism behind it. Any economy that relies on money printing to cover deficits, any nation that loses market confidence in its domestic currency, is walking the same path. A currency crisis does not happen overnight. It accumulates over years of delayed policy action, through temporary decisions that become permanent. So the question for you is, if a country's currency depreciates faster than income growth, who is truly paying the price? And more importantly, where is the point of no return for an economy once trust has begun to fracture? Part 1: The oil curse. When resources become a trap. If a country possesses one of the largest oil reserves in the world, our intuition tells us that country must be wealthy. But economics does not operate on intuition. It operates on structure. Iran pumps millions of barrels of oil each day. For many years, oil has accounted for the majority of foreign currency earnings and national budget revenue. The problem is this: when money comes too easily, the pressure to reform disappears. This is the foundation of what economists call the resource curse. Look at how the mechanism works. When oil prices are high, The budget is abundant. The government expands spending, subsidizes energy, food, and welfare. Society becomes accustomed to a standard of living that is price-supported, but oil is a commodity that fluctuates with global cycles. When oil prices fall or exports are restricted, foreign currency revenue contracts immediately. Meanwhile, the spending system has already expanded and is very difficult to cut. The result is rising budget deficits. And as analyzed earlier, printing money becomes the easiest option. The biggest trap of an oil-dependent economy is the lack of diversification. When 50 to 60% of foreign currency earnings come from a single commodity, the economy loses its shock-absorbing capacity. Successful Middle Eastern countries, such as the United Arab Emirates or Saudi Arabia, have used oil revenue to invest in tourism, finance, technology, and logistics. They treat oil as seed capital to build a post-oil economy. Without strategic reinvestment, oil simply creates a consumption-based economy sustained by subsidies. Another consequence that is less discussed is the Dutch disease effect. When foreign currency inflows from oil surge, the domestic currency tends to strengthen during favorable periods. This makes domestic goods less competitive compared to imports. Manufacturing and agriculture gradually weaken. When oil faces disruption, other sectors are not strong enough to replace it. The growth engine has no backup motor. In Iran, oil dependence is not only an economic issue, but also a structural power issue. Revenue is concentrated in the energy sector, where the state maintains strong control. When cash flow is concentrated, economic power is also concentrated. This reduces the role of an independent private sector, which is the primary driver of innovation and long-term productivity growth. An economy lacking competition will lack efficiency. Fuel subsidies are the clearest example of this cycle. Low energy prices help citizens in the short term, but they distort market signals. People consume more than necessary. Smuggling emerges due to price differentials. The budget must spend tens of billions of United States dollars each year to sustain the subsidy system. And the paradox is, this oil revenue earned abroad is recycled to cover losses from selling oil cheaply at home. The key point is not whether a country has oil or not. The key point is how resources are managed. Resources can be a lever for development, but without institutional reform, without fiscal discipline, without a diversification strategy, they become a cushion that allows the economy to delay change until a shock arrives. So the question becomes, when a nation has grown accustomed to living off a single revenue source for decades, does it have sufficient political incentive to cut that dependency itself? And if not, what happens when that revenue source continues to be squeezed by price volatility and external pressure? Part 2. A locked economy. When the global financial system shuts its doors, a modern economy can endure inflation. It can withstand recession cycles, but it struggles to survive when it is cut off from the global financial system. After financial sanctions, Iran was largely removed from the international payment network. This means domestic businesses cannot transact normally with the world. Banks struggle to access international capital, and foreign investors almost disappear. In the past, Iran attracted billions of United States dollars in investment each year. When the financial door closed, capital flows reversed. And in economics, capital is not just money, it is technology, management, and productivity. When foreign capital withdraws, the private sector loses oxygen. Companies cannot borrow foreign currency, cannot import components, cannot expand production. The automotive industry lacks spare parts. The electronics sector lacks raw materials. Labor productivity declines. Gross domestic product growth does not just slow, it loses structural momentum. At the systemic level, financial isolation creates three dangerous consequences. First, transaction costs rise sharply. When payments cannot move through international banking systems, transactions must take detours through intermediaries, black markets, or cryptocurrency. Each additional layer is an added cost. Businesses lose profit margins. Consumers pay higher prices. Second, country risk increases significantly. When international banks assess an economy as being at risk of violating sanctions, they refuse to lend or provide trade financing. Domestic interest rates must rise to compensate for risk. Capital becomes expensive. And when capital is expensive, long-term investment is nearly paralyzed. Third, the domestic currency faces constant pressure. When United States dollar inflows are insufficient, foreign exchange becomes scarce. The exchange rate becomes highly volatile. The central bank is forced to intervene or tighten capital controls. But the tighter the controls, the more the black market expands. This is the spiral of collapsing confidence we observed in Part 1. Many believe cryptocurrency could be an escape route. In reality, crypto is only a situational solution. It may help certain transactions bypass barriers, but it cannot replace commercial banking systems, cannot create long-term credit, cannot build bond markets or finance large-scale projects. An economy cannot develop sustainably without a stable and internationally recognized financial system. Another under-discussed factor is ownership structure. When most strategic industries are controlled by the state or conglomerates closely tied to political power, competitive incentives decline. Without competition, there is no pressure to improve efficiency. When efficiency is low, production costs are high. When costs are high, domestic goods are less competitive. And when exports fail to grow, the economy becomes even more dependent on a single revenue source, oil. What we are seeing is a closed system. Financial isolation, capital shortage, production decline, unemployment, social instability, tighter control, deeper isolation. The most concerning issue is not short-term recession. It is the long-term erosion of productive capacity and market confidence. When educated young people cannot find opportunity at home, they look for ways to leave. And when human capital exits the economy, that loss may not immediately appear in gross domestic product figures, but it will surface 5 to 10 years later as structural stagnation. The important question here is, can an economy reform itself internally while remaining locked externally? Or does meaningful reform require a certain degree of integration to succeed? Part 3. What is Iran's way out? Reform or continuing the spiral? At this point, the key question is no longer what problems is Iran facing, but rather, can it break out of its current structure from a purely economic standpoint? The way out is not mysterious. The formula has been applied by many countries that went through crisis fiscal discipline, gradual subsidy reform, restructuring state-owned enterprises, progressively reopening capital flows, and diversifying the economy. The problem is that economic reform always carries political costs. Let us begin with energy subsidies, the largest bottleneck in the budget. When a country spends tens of billions of United States dollars each year to keep fuel prices below market levels, that is no longer social policy, but a distorted fiscal structure. Yet, if subsidies are cut abruptly, inflation surges and social backlash intensifies. Therefore, the only viable solution is a phased roadmap. Gradual price increases combined with direct support for low-income groups. This is not theoretical. Turkey and Jordan have followed similar approaches to avoid social shock. Reform must be designed as a transition strategy, not as a sudden jolt. Second is economic diversification. Oil cannot remain the sole pillar indefinitely. Iran has potential in petrochemicals, high-value agriculture, technology, logistics, and especially cultural tourism. But potential does not automatically translate into growth. It requires a transparent business environment, a normally functioning financial system, and investor confidence. If the private sector is not granted genuine competitive space, any diversification strategy will remain on paper. Third is restoring monetary credibility. A domestic currency stabilizes only when the market believes the government will not use it as a tool for unlimited deficit financing. That requires controlling money supply growth, ensuring budget transparency, and limiting money printing to cover spending. This is a fundamental lesson from every currency crisis in history, from Latin America to Southeast Asia in 1997. But all these solutions require a prerequisite: reducing isolation. No economy in the 21st century can grow sustainably while standing outside the global trade and financial system. Capital flows, technology, export markets, all depend on international integration. Without connection, domestic reform efforts are constrained by resource limitations. However, the harsh reality is that reform always creates short-term winners and losers. Groups that benefit from the current structure will not easily surrender their advantages. This is what traps many economies in a middle-income trap or an institutional trap, not because they do not understand the solution, but because the cost of change is too high for the existing power structure. So which direction will Iran's future take? Two clear scenarios emerge. The first scenario, maintaining the current model. This implies prolonged high inflation, low growth, elevated youth unemployment, and brain drain. The economy does not collapse suddenly, but it erodes gradually. The second scenario, gradual, controlled reform, accepting short-term costs in exchange for long-term stability. This does not guarantee immediate success, but at least it creates a new trajectory. The most important takeaway from this story is not limited to Iran. It is a lesson for any country dependent on resources overspending beyond its capacity and losing confidence in its currency. Economic crises do not begin on the day people take to the streets. They begin with small fiscal decisions, repeated over many years. And the final question for you. As someone interested in economics and finance, if an economy loses confidence in its currency, depends on a single revenue source, and is isolated from global capital flows, what do you believe must change first? Monetary policy, fiscal structure, or the power structure itself? Share your perspective, because economics is not just numbers. It is the future of an entire generation.